Okay, we are back on the record in case number 2024-276, electronic application of Atmos Energy Corporation for an adjustment of rates, approval of tariff provisions, and other general relief. And if you're ready, Mr. Cook, can call your first witness.
Thank you, Chair. The AG calls Mr. Lane Collin.
Good morning, Mr. Collins.
Good morning.
Welcome back. Raise your right hand to be
Thank you.
sworn, please. Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
Yes, I do.
Good. Please have a seat. Tell us your full name and business address.
My name is Lane Collin. My business address is J. Kennedy and Associates Incorporated, 570 Colonial Park Drive, Suite 305, Roswell, Georgia, 30075.
Okay, Mr. Cook.
Good morning, Mr. Collin.
Good morning.
Were you the same Lane Collin who caused to be filed direct testimony and responses to data requests in this case?
Yes,
Okay. Do you have any changes or additions to make to those?
I do not.
Okay. And if you were asked the same questions today, would your answers be the same?
Yes.
Okay, thank you. The witness is available for cross.
Good applicant.
No questions.
Mr. Sack.
Thank you. Good morning, Mr. Collin.
Good morning.
I apologize, I'm going to be jumping around quite a bit as you cover several topics that we talked about yesterday, so
Sure.
I apologize if you end up with whiplash over that. First, I wanted to ask you about your testimony in which you recommend, and please correct me if I mischaracterize any of your testimony, that the shareholders bear the burden for 50% of the cost of directors and officers' insurance. Is that the correct characterization of your?
No, that's witness Futrell
Oh,
to
okay.
address that.
I apologize. We'll ask him about that then. Was it your testimony? Did you? Let me actually look at your testimony before I ask you the next question.
And while you're doing that, I'll just say that we're having a little bit of a tech issue this morning. If we need to go into confidential session for any reason, I will need to go off the record and get that lined out. So just bear with me if that happens.
Thank you.
Okay. You did testify about the PRP program,
Correct.
in which you cited delay in replacement of bare steel as a reason for not allowing accelerated replacement of aldelay pipe, correct?
Yes, the company has not executed well on the replacement of bare steel and coated steel pipe, and repeated delays, repeated cost overruns, substantially more expensive than the initial estimates. The commission has been frustrated with this over the years and has addressed it through various orders, including caps on the PRP capital expenditures.
Now, in your review of the PRP filings, would you attribute any delay in replacement of the bare steel to the caps themselves?
Well, that's, I understand Atmos has made that assertion in those PRP proceedings. But the problem is that it's essentially a self-fulfilling outcome. If you don't get the work done earlier, then of course it costs more later. And they did not execute well against their plan that was approved initially by the commission. And for that reason alone, although there are other reasons, I don't recommend that the commission expand the PRP program to include the Adel A pipeline replacement. That's a completely open-ended ask. There's no cost estimates for the entire replacement program. There's no timeline. It would just basically perpetuate the same problems that the commission has seen with the replacement of the bare and the coated steel pipeline.
If the commission were to permit accelerated recovery for replacement of aldelay or recovery under the pipeline modernization rider that Atmos has proposed, what, if any, changes to the tariff would you recommend to ensure that nothing was being included in those riders that, beyond what was discussed yesterday by Mr. Austin, I believe it was?
Yes, well, the company's ask in this case is to put the ADL A, have the commission approve an open-ended program to replace ADL A pipeline on an accelerated basis and recover the cost of that through the PRP rider. Now, with respect to the PM rider, the pipeline modernization rider, that's really an open-ended rider. If you look at the proposed tariff that was included in the company's filing, it said, hey, anything that is necessary to comply with what we refer to as the mega rule can go through that rider. And that, in my opinion, would include the ADL A pipeline as well. So, and obviously the company has made a point of saying, well, the initial projects will be only the list that was attached as an exhibit to Mr. Austin's testimony. But the tariff itself is completely open-ended in terms of compliance with the mega rule. And so there really are no restraints there. So I would conclude that the company could at some point seek to recover the ADL A pipeline replacement costs through the rider PM if it's approved, which I don't recommend, even if it doesn't get approval through the PRP rider. So it's just another vehicle for recovery, if in my assessment.
Are there, in your mind, any benefits, or, I mean, you can tell me benefits or downsides to having a separate PM rider separate from the PRP rider as opposed to just amending the PRP rider to include whatever the commission sees fit to approve?
Yeah, I don't think so. The PRP rider right now is limited to bare and coated steel pipeline replacement. And I think all of the coated pipeline that was going to be replaced has been replaced, and there's just a certain number of miles left of bare steel. But with respect to the rider PM, I think that the better regulatory approach is to continue to allow recovery through base revenues. It's not like the company doesn't get recovery of the cost of compliance with the mega rule. It does. But right now it's essentially recovery through base revenues with a forecasted test year. So, there may be some little bit of regulatory lag in there, but the company is able to recover its costs, subject to what I would characterize as minimal regulatory lag without a rider, and has been doing so since the early 2000s, I think, when the mega rule first started rolling out, at least in proposed form. So I don't see any reason to now approve, adopt an open-ended rider to recover any cost that the company identifies as necessary to comply with the mega rule.
If some additional language were put into the tariff to make it not open-ended, so without that argument you just made, what is your response to the testimony from multiple Atmos witnesses yesterday, and in particular, I believe Mr. Austin, his statement that including ADL A under the PRP rider and implementing a PM rider would give Atmos a earlier planning window so they can, not necessarily start replacing the ADL A before the bare steel, but budget accordingly for the ADL A in advance.
Yeah, I still do not think it's good regulatory policy to include an open-ended, undefined ADL A replacement program in rider PRP. We don't know what the estimated cost is going forward. We don't know if it's a $400 million undertaking, a $500 million undertaking. Will it take 5 years, 10 years? I think the commission needs to assess this program on its merit, and there isn't enough information in this proceeding to do so. In fact, the Attorney General asked repeatedly for information about the estimated costs and the timeline, and the company refused to provide it and said, well, we can't do that at this time. Well, then I don't think the commission should approve a rider recovery of the ADL A. What the commission has done in the past, and I think is appropriate regulatory policy, is allow recovery of specific segments of the ADL A pipeline that has a high risk associated with it. And I think that's appropriate. In other words, on a selective basis. And then as far as the PM rider, I don't think it should be open-ended. The company presently has recovery of these costs through the base revenues. And I just don't know of any way to sufficiently bound these riders to avoid the open-ended nature of what the company has requested. If you put a cap on the PM for the mega rule requirements, then you'll have complaints about that. But I think having the recovery through base revenues essentially provides the company reasonably timely recovery, particularly with a forecast test year. And it also provides the company an incentive to control costs, because to the extent that there is regulatory lag, then they're on the hook temporarily, and really only for carrying charges and depreciation primarily. Maybe for a year or two if there's a 3-year window on rate cases, between rate cases. But if you put these costs into the PM rider, it's open-ended, and the way the tariff's written, I don't know of a way, quite frankly, to bound that short of caps, and we know that that has its limitations as well. Because what happens is that you will cap out today, but then it blows up and comes out of the encasement, if you will, later on. So I just think the present form of recovery through base revenues is the best regulatory approach. Gives the company reasonably timely recovery. It can spend whatever it wants or needs to spend, subject to justification, if the commission or another party questions it. So there are no caps, hard caps anyway, on expenditures to comply with the mega rule.
When you said you didn't have information from Atmos regarding the timeline, were you referring to ADL A or the
Yes.
PM or both?
Oh, actually, both. And both are open-ended without defined specific cost estimates or timelines, except for limited projects that the company proposes to put into the PM rider at this time, according to that list of Mr. Austin's testimony. But that's really the problem. It's open-ended. The commission loses control. You're really not effectively regulating the spend rate, and you become takers as regulators as opposed to overseers, in terms of the reasonableness of the costs.
I had written down in my notes from Mr. Austin's testimony that he expected a 7 to 10 year timeline for replacing all the ADL A. Does that information change any of your opinion?
It does not. There was a much earlier completion timeline for the bare steel, as we've talked about previously, that's just been blown through repeatedly. And I would expect something similar, because the company simply does not execute well and refuses to provide a cost estimate or an actual timeline against which the commission could assess the progress and whether or not the company had executed well.
They gave us a number of miles.
Yes, that's true. That's true, but on an open-ended cost. And the AG asked Discovery and said, well, when do you actually expect to complete the bare steel replacement and the recovery through the PRP rider? And they said, well, that depends on what we run into, you know. They refused to provide a timeline or a cost estimate. Now, I know that Mr. Austin yesterday threw out something like $42 million a year. They could have it done by 2028. Well, that's new information to us. We asked for that information, and they couldn't provide it. But Mr. Austin threw that out yesterday, but I don't believe that was a cap that he was looking at or a commitment to you. And this has just been a real problem with this utility, and that's why we think they should be treated differently than Delta or Columbia or Duke Energy Gas, or for that matter, LG&E Gas, because they don't execute well. The other utilities do. Cost overruns, time delays.
You recommend the cap stay in place?
Recommend against?
You recommend that the cap stay in place?
Oh, yes, yes.
And
I-
the reason is, the overarching reason you would recommend that is that they're not executing well on their pipeline replacement.
That's right, yeah. And it's the one area of some degree of control that you have, because let's say you remove the caps, and then all of a sudden they spend $50 million a year for the next 5 years, so you've ended up with $250 million spend to replace the remaining bare steel pipeline.
This company keeps their prices low, though. I think they're the lowest cost gas company in the state.
Yeah, that's what they've claimed, but, you know, there's a lot of things that go into the rates that are charged to customers. And I know you know this, but it's the amount of investment, it's the amount of the expenses, it's the allocation of the total revenue requirement to customer classes. And I think what the claim was yesterday, we'll have, if not the lowest, one of the lowest residential rates. Well, that doesn't really speak to the overall cost. It doesn't really speak to anything other than that's where the residential rates ended up. And that claim was with respect to base revenues. I believe, Madam Chair, that you asked for clarification on that point. And the witness said, yes, that's just the base revenues. It doesn't include the PRP rider. It doesn't include any of the other riders, like the PGA, for example.
I'll let staff get back to the questions.
And Chair, I just wanted to mention that we plan on issuing a post-hearing data request asking for updated cost information for both the PM and the Adelaide replacement with and without cap. Regarding the PM rider, do you have an opinion on, so if you're contrasting PM rider versus recovering for PHMSA-related replacements through base rates, is there a difference in, I'm not sure quite how to phrase this, who it's recovered from a timing standpoint? Obviously, there's going to be some overlap between who customers are now and who customers are 10 years from now. But is there any problem with the PM rider as far as charging customers earlier for benefits that maybe cover a slightly different time period than if you recovered for it in base rates?
Yeah,
Did that make sense?
It does, yes. I don't think there's really a significant difference there. But I do, you know, I recognize that there will be, if you step back from that more detailed question, if you step back and look at the type of recovery through a rider, it's basically contemporaneous as you spend the money, as opposed to base revenues where you have a forecast test year and you may or may not spend the money in that actual year that is consistent with the projected test year, and then what the company does after that until the next base rate case. There may be some differences there, but ultimately the company will recover 100% of its prudent and reasonable costs, regardless of the the vehicle. The question is, what are the incentives, what is the appropriate regulatory policy that drives putting the costs into a rider as opposed to recovering them through base revenues? Then, with respect to the more specific question that you asked about, are there differences between recovery from certain customers? There may be a little bit of intergenerational overlap or disconnect, but the costs under the proposed PM are allocated on the basis of the allocation methodology reflected in the company's prior rate case, base revenue case. And that, as a general rule, probably is appropriate. So,
Which is more appropriate as a general rule?
the company has proposed an allocation to customer class for the PM rider that is based upon the allocation methodology adopted in the most recent base rate case. I think that's maybe paragraph 5 in the proposed rider. But, you know, as I mentioned before, the risk of belaboring the point, the risk, though, is that it's an open-ended recovery rider. Anything that the company deems necessary to comply with the PIMSA requirements can go through that rider. You know.
What would be your suggestion to make it less open-ended?
Well, Mr. Austin was suggesting yesterday that there was a limited set of projects that they were requesting in this case. And he said that might sunset the PM rider tariff then after that. But realistically, if you look at the proposed language, the language in the proposed tariff, it's open-ended. And so the company comes in to the commission in a PM rider proceeding and says, we want to add these 15 projects or 100 projects or whatever the case may be. You're going to get incremental to death. And that PM rider, in my assessment and my experience over the years, is that rider will never sunset.
Are you disagreeing with the allocation methodology?
No, not at all.
Oh, you
No,
agree with that,
no.
okay.
That was just a question
Okay,
from staff
thank you.
counsel, right. No, not at all. I said, in fact, that probably is as reasonable an allocation methodology as any.
Okay.
Commissioners, before I move on to the next topic, are there any more questions you'd like to ask him about the PRP or PM riders?
It's either way. It's fine. Go ahead.
All right, Mr. Collin, I wanted to jump to another rider, the R&D rider, which you've talked about briefly in your testimony. Believe you indicated that you felt that the suppliers of natural gas equipment would pick up the cost of the R&D expenditure if this rider were to be dropped. Can you explain that for me?
Yes, the industry, whether it's pipeline manufacturers or whether it's consumer appliances, for example, gas furnaces, they have their own research and development and their own processes, manufacturing processes, and their own safety and reliability concerns that they can build into their products and differentiate themselves from the other competitors in that same market space. And the question is whether or not ultimate consumers, gas consumers, should have a fee imposed upon their rates to in turn then do some kind of additional research and development that is available to these manufacturers. It seems to me that it's best to place that and leave it on the producers of this equipment and these materials and let them deal with it. It's a marketplace issue, really, not something that should be imposed on ultimate customers.
Do you think it would be accurate for me to say that ratepayers are going to be paying for it either way in the form of either continuing to pay this rider or in the form of, like you said, manufacturers of gas furnaces, building that R&D cost into the cost of their product, which eventually, those technological advancements are going to be paid for by customers.
Yeah, I don't think there's an equivalence. And I think that the manufacturers and the suppliers of materials like pipeline materials, they're doing their own research. It's not clear that they actually rely upon anything coming out of GTI. The company has made the claim that, the research improves certain reliability aspects of the utility operation. Well, they have other organizations that do that as well. And I don't think that if GTI is not funded, that all of a sudden there will be a rise in other, an equivalent rise in other research and development that in turn will flow through to ultimate customers in increased costs for pipeline or end-use customer appliances. I don't see that there's an equivalence at all there.
Do you see any benefit at all to Atmos's shareholders in keeping the R&D rider?
I don't. I think they should be indifferent because they only fund GTI if they collect the amounts from customers. So if the collection goes to zero, then the funding goes to zero, and there's no effect on shareholders one way or the other.
So going back to, I think Mr. Taylor testified that the R&D rider had its roots in a 1999 order. To your knowledge, is there anything that's changed about anything in the industry that would change the analysis of whether or not the commission should keep this rider now as opposed to how it affected ratepayers in 1999?
Yeah, I'm just requesting and recommending that the commission revisit this. On behalf of the AG, I believe I opposed it in 1999 as well, but I just asked the commissioners to revisit it, and if this is really an appropriate regulatory policy to recover these funding costs from customers.
Mr. Collin, in your direct testimony, you recommended that the commission account for delays between the billing and payment of vendors for construction expenditures as zero-cost capital, correct?
Yes, that's correct, and that's consistent with the commission's order in the last Atmos base rate case.
Now, if I recall correctly, Mr. Christian responded in part by stating that the commission should not do that because Atmos does not include construction work in progress in rate base. Is that your understanding of his testimony?
Yeah, that's my understanding of his testimony. I don't think that's a relevant point. This is ultimately ratepayer money, and it's a current savings essentially on a recurring basis, and ultimately that construction work in progress plus AFUDC will be included in rate base. This is just a way of properly capturing all of the costs of the utility. So I don't think it's necessarily true that if the QIP is not included in rate base, that the related accounts payable should not be subtracted from rate base. And the commission agreed with that assessment in the last case and subtracted the construction-related accounts payable for the delay in the payment after the costs are incurred for the construction until the vendors are paid. So let's say you have a concrete vendor or something like that. If you're building a foundation for, let's say a compressor station, it's not a lot of money, but nevertheless, that vendor isn't either paid on the date when that cost is incurred or before. That vendor is paid at a later date. And so that's basically cost-free capital until the vendor actually is paid. And this is a process that's ongoing. The company acquires services or materials and supplies, assets, and then pays for them later. And if those costs are expensed, then that's captured in the cash working capital calculation. If, on the other hand, they're not expensed, they're capitalized, then that needs to be captured in the rate base. So you have two different places for two different types of costs, that although they seem similar, they're not. So,
And do you know whether they're expensed at the time?
we know from their accounting records whether they're expensed or not at the time. So for example, if the costs go to construction work in progress, then that is capitalized, it goes onto the balance sheet as an asset. And then there's a related liability for the construction accounts payable. If, on the other hand, it's a maintenance repair, then it goes onto the income statement as an expense. And if there's a payable, there would be a related accounts payable, but that lag in the payment of the expense is captured in the cash working capital. So two different types of costs, two different types of rate-making treatment that are conventionally distinguished in the rate-making process.
So then, I'm not sure I completely understand that. Are you asserting that some part of what they're saying is not part of rate base is part of rate base, or are you saying that it is not part of rate base, but you disagree that it's not zero cost capital?
Well, I can't answer that one yes or no, that's kind of compounded, but the quip in rate base is not the determining factor in this case. There is a lag in payment, regardless of whether it's construction work in progress that is or is not included in rate base. And that lag needs to be captured someplace. You had a discussion, I believe, yesterday with one of the Atmos witnesses whether or not that lag is captured in the AFUDC. Some utilities do capture that lag in AFUDC. And if Atmos does, then that's great. But if not, then it needs to be captured in the construction accounts payable. The first time I've heard this argument from Atmos, and as I said, the commission ruled on this in the last case that it should be subtracted from rate base.
All right, I'm going to move on to NOLC, ADIT. Assuming Atmos could perform the calculation from a point at which they had no NOLC ADIT asset, do you have an issue with Atmos's actual methodology for calculating increases and decreases in that asset on a Kentucky-specific basis?
I do. And the reason, the difference that I have with Atmos is that they are arguing that the entirety of the NOLC, I call it a DTA, other people in the industry call it a deferred tax asset. But in any event, it's an addition to rate base. And it's for a cost that the utilities don't necessarily incur because part of that loss is monetized at the corporate consolidated tax return level. But the company, first of all, would have you ignore that. So that's the first difference. And I described that in my testimony. I won't belabor the point. But then beyond that, the question is, what are the temporary differences? This means the book tax differences that give rise to the ADIT. Which ones are or are required to be included in rate base to avoid a so-called normalization violation? And we finally have winnowed this down through discovery with Atmos that it is correct that the only ADIT, that NOLC ADIT that needs to be included in rate base is that necessary to avoid a normalization violation. They want the entirety of it, but the only portion of that that is required is the difference between the tax depreciation and the book depreciation. Their methodology does not distinguish, okay? They are on an everything is all in basis. But my recommendation is to limit it to the tax depreciation versus book depreciation difference. And also then, because they assume last dollar deducted methodology, then I recommend a first dollar utilized methodology in the years in which Atmos has taxable income, or the Kentucky division has taxable income. And again, I explained this in my testimony, so I won't belabor it, but.
Do you have Atmos's data request responses in front of you?
I don't.
I'm going to represent to you that in Atmos's response to staff's third request, they had indicated that the primary driver of the increase in the liability balance of ADIT for Division 2 during fiscal year 2022 was an increase in the net value of the interest rate agreement cash flow hedges. Do you have an opinion regarding whether increases or decreases in the net value of those hedges should be reflected in rates?
I do. I do have an opinion on that, and the answer is no. They should not be reflected in rates, just like unregulated activity should not be reflected in rates. And the reason for that is that, you know, regulation, particularly here in the Commonwealth, is, and on the tax issues, historically has been limited to the four corners of the utility itself, rather than other divisions, other unregulated activity, other consolidated tax costs, but limited really only to the tax depreciation, less the book depreciation and the ADIT that is caused by that. So.
That's all, Chair.
Mr. Coiler asked the question about the construction that I was curious about. You made a comment that this isn't a way to do regulatory oversight, removing the caps. Do you have a recommendation for what would be a better option?
I do. If we could go back in time, I would never have adopted the pipeline replacement rider, the PRP. And because it takes away the natural incentives that are available or reflected in the base rate-making process, and that is where the company comes in on a forecasted test year and then, you know, attempts to get a rate increase based upon this forecast cost structure, and then they have to manage their business to live within that cost structure until they file their next base rate case and start the process all over again. And that has served well for 100 years in this country. But when you have a subset of the costs that can be recovered through a rider, it tends to incentivize the utility because, in my assessment, there's a natural incentive in the process. It tends to incentivize the utility to spend more and take longer. Whereas if it's on their own, if it's on them, when they get it done, how much they spend between rate cases, there's a natural incentive to really focus in on that cost and getting the job done, to execute well.
Are you aware of any other states that have this type of rider or have done a rider before?
There are many states with riders,
Okay.
yes. But there are states as well that, you know, don't have this type of capital cost recovery rider.
Okay.
So, but some states do. I mean, there's really a diversity of experience among the states.
Have you looked at or done any research into the ones who have the capital cost rider?
I have.
Enough to give an opinion on how you think that's working in that state?
Well, I could tell you we have the same problem in Texas.
Okay.
We represent clients in Texas before the Railroad Commission of Texas in cases involving Atmos, and we see the same experience there, but they don't have caps. So.
Okay, thank you.
Good morning.
Good morning.
Just a second here. I was making notes yesterday about things I wanted to ask you about, so I'll have to flip back through a little bit. So one of the witnesses for the applicant made note of the fact that although you're an expert in a number of subjects, that you're not necessarily an expert in pipeline replacement. And that they are required to make some of the pipeline replacements that you're suggesting they not do.
Well, I think that's incorrect.
You just get 1 second.
I'm sorry.
No worries.
I apologize. I don't know why it went off.
I didn't make my usual admonition this morning to remind everyone to turn off their cell phones. In fact, I'm gonna make sure mine's off right now. I'm good, okay. It happens. Sorry, go right
That's not an accurate statement. I have not addressed the need for the pipeline replacement. What I have addressed is the form of recovery for the pipeline replacement. And, you know, the company basically has a lot of testimony about the need for pipeline replacement or the need to comply with the mega rule requirements. I do not dispute that. What I do dispute is the form of recovery proposed by the company. First of all, through the PRP with no caps.
So they'd get recovery regardless, just
They
maybe
do.
not accelerated recovery.
That's right, yes.
Through the rider.
Exactly
So your-
right,
your
yes.
point is- Okay.
So I don't know where Atmos came up with the idea that I was opposed to pipeline replacement projects or compliance with the mega rule requirements, because that just simply is incorrect.
Okay, and you don't believe that PHMSA has a required timeline for these replacements? That we're just
Well-
using an open-ended company?
Well,
Created
on a
timeline.
broad basis, there are ongoing requirements. I think there were certain specific pipeline projects that the company said needed to be completed by 2028 or 2035. They can complete those regardless of whether they have proposed modernization rider, or pipeline modernization rider. They can still complete those projects by 2028 and 2035. I've never disputed that. But there are other requirements of the mega rule, other CapEx requirements, other ongoing maintenance, operation and maintenance expense requirements. They haven't asked for those through the modernization, the pipeline modernization rider yet. But I think that, you know, they've left it open that they can expand that rider or the costs that would be recovered through that rider. It is not limited only to, I think they refer to it as the 264 pipeline projects. That rider is not limited to those projects, despite the testimony of one of the witnesses yesterday.
Okay. You're familiar with the service territory for Atmos. I'm sure you're a Kentucky native, right? You live in
No,
No.
Ohio native.
Ohio, but okay.
Yeah, close, I guess.
Okay.
But,
You're familiar with their territory, though?
Yes, to some extent. Now, I can't speak to specifics. I think Mr. Austin was talking about Paducah yesterday and things like that. I can't speak to that.
You wouldn't argue that there's excessive or unusual for the rest of Kentucky economic development in their area, at least lately?
There's been a lot of economic development throughout Kentucky,
Mhm.
and I don't know that Atmos is unique. I don't think it is.
Bowling Green area, for instance, has
Yeah.
a lot of economic development lately.
Yes, yeah. In Lexington.
Is there a danger that they can't keep up with the amount of pipelines that are going to need to be extended and expanded if we don't give them the rates they're requesting?
Well, they have the ability to forecast their test year. So they have a forecasted test
Mhm.
year that ends March of 2026. So they have a whole year, and they came in with their own forecast of what they were going to spend. I haven't disputed any of that.
Uh-huh.
And that includes economic development. It includes the Adelaide pipeline. It includes the pipeline modernization projects with respect to compliance with the mega rule. All of that's in there. And historically, those costs have been recovered through base revenues. You know, it's not a question of do they need to or should they meet the needs of a growing customer base. It's the question of where do they get recovery.
And do you have an opinion about the allocation as far as residential versus non-residential when it comes to these replacements in economic development?
I have not.
Okay.
I've not addressed that.
This company is still receives an A rating,
That's correct.
and that's a good thing for its customers.
Yeah, I think it is, because there's a number of reasons why that's a good thing, yes. And
And-
Mr. Baudino can really speak to that
Okay.
probably better than I can.
I'll
but-
wait and ask Mr.
Okay.
Medina the rest of the questions about that then. If you had the opportunity to weigh in on some guidelines or parameters for what you're referring to as open-ended spending. Removing the caps but adding some guidelines, what would you suggest?
There's a number of different ways to approach that. I think I've had testimony in other jurisdictions where one way to approach that is an annual escalation in a cap. It still provides a guardrail, but it also opens the cap a little bit each year.
I mean, costs are going up.
Yes,
That
yes.
no one thinks costs are going down.
Right, right.
Yeah.
But again, stepping back, one of the reasons why the company is exposed to these cost increases on the bare steel that remains to be replaced is because it wasn't done on the time schedule
Mhm.
and at the lower cost on that time schedule in prior years. So, you know, it's a problem of the company's own making, in a sense. So,
Mhm.
but, you know, that's one option in terms of maintaining a guardrail in the form of caps. But, you know, it still does not address the fundamental problem of recovery through a rider like this without any restraints, you know, other than the timing of the caps.
Okay, so the problem is not the caps as much as
The form of recovery and the incentives
the way the
inherent.
riders are structured.
That's right, yes.
You've recommended against an additional PM rider.
Yes, and if I were able to go back and address the PRP, I would recommend against it as well for the same reasons.
Altogether.
Yes, altogether.
And just roll
yes.
that into the regular rate.
Yeah, absolutely, yeah. There's no reason to have that as a separate rider, but I know the commission's has approved riders for other utilities as well, and that's just the reality.
Mhm.
But in my experience, and based upon being a witness in a number of these
Mhm.
other utilities cases, the other utilities have executed well. They've achieved their replacements of whatever the pipeline, you know, whether it's bare steel, coated steel, or whatever the other costs are, through the riders, and then the riders have basically
So-
terminated.
Yeah.
And they've done a good job of that. Atmos has not.
I'll ask for follow-ups and then redirect. I'd like to do redirect all at once. Are there follow-ups?
Just have one question, Mr. Collin. Just to clarify, I thought I heard you say this, so I apologize if this is redundant, but I just wanted to make sure, I thought I heard you say that in this case, the company has included at least some cost to comply with the mega rule. Is that true?
Yes, that's correct, yes.
Okay. I think that's all I have, Chair.
Okay. Any reason why we couldn't excuse Mr. Collins? All right, thanks for coming in.
Thank you, very good to see you again. Thank you.
Mr. Cook, whenever you're ready, call your next witness.
The AG calls Mr. Futrell.
Good morning, Mr. Futrell.
Good morning.
Would you raise your right hand to be sworn? Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
I do.
And you've been here before too.
Yes.
So welcome back.
Thank you.
Tell us your full name and business address, please.
My name is Randy A. Futrell. I work with the firm J. Kennedy and Associates, Inc. Address is 570 Colonial Park Drive, Suite 305, Roswell, Georgia, 30075.
Good morning, Mr. Futrell.
Good morning.
Are you the same Randy Futrell who caused to be filed direct testimony and responses to data requests in this case?
Yes.
Okay. Do you have any changes or additions to make to those responses and testimony?
No.
Okay. If you were to be asked the same questions today, would your responses be the same?
Yes, they would.
Okay. The witness is available for cross.
No questions?
Yeah. With respect to property taxes, are you familiar with how the Commonwealth Department of Revenue and local governments determine the value of the property to which they apply the ad valorem taxes?
Yeah, my understanding is they use a unit value method, and it's based in part on the level of plant assets and in part on net operating income. Our understanding in working in a number of cases throughout the state, a number of witnesses have told us that the state relies more on the net operating income piece of it than they do the plant assets. But they determine a real property value and a tangible or a personal property value and add those together, and then the localities generally use those estimates in determining what it's going to charge in property taxes.
When they determine, to the extent that they're basing it on the value of property, are they basing it on the value of property at the end of a year, or kind of the average over the year?
They're basing it on the property as of January 1 of that new year. So for property taxes to be paid assessed and paid for 2024, they're going to assess that as of January 1, 2024.
Okay. Are you familiar with the Exhibit 2 to Mr. Waller's rebuttal testimony? It was the property tax bill that was talked about
Yes.
quite a bit yesterday.
Yes.
So that was a bill, I think, from maybe it originated in, well, I guess let me just ask you the question. Was that bill intended for, would it have been based on the value of property as of January 1st of 2025 and was intended for it to be the property tax for 2025, or was that the property tax bill for 2024?
I don't know exactly. I do know that that Mr. Waller stated in rebuttal that they had just received that bill. So my assumption was it was the January 1, 2025 assessment based on property throughout 2024 and as of January 1, 2025. I have no reason to believe that that is not the case, because they would have received, notification for 2024 in early 2024, and then had the chance to dispute it.
Moving on to lobbying fees, did you review Mr. Waller's testimony and the testimony that he attaches as an exhibit from the American Gas Association with respect to their treatment of lobbying costs?
I did when he first filed the testimony, yes.
Okay.
Apparently, the FERC had asked comments on AGA Association dues and whether or not that should be included in revenue requirements, and what different assessments were from different commenters. And that document was what the AGA filed with the FERC to justify what it thought was a more appropriate way to look at the revenue requirement.
Sure, and they lay out kind of a methodology for how they determine the portion of their dues or their costs which would be allocated to lobbying, is that right?
They do in some respects, and if you were to have looked at the invoices from the AGA to the utilities over the last, I don't know, maybe 5 or 6 years at least, there's a little notation at the very bottom of each one of those bills that lobbying costs are 4% of this bill, or something like that, a very low percent. And you can see those percentages. Mr. Waller actually made note of the low percentages that are deemed to be lobbying by the AGA, but in most respects, the utilities didn't really have an idea of what that meant, but they would normally put that below the line in account 426.5 and then remove it from their revenue requirement. But the commission has stated on a number of occasions, including the last Atmos case, that not only are there lobbying costs, but there's also other political activity costs like legislative advocacy, public relations cost, and that sort of thing, that they didn't really have a good guide point on what the AGA may or may not have been spending on those types of things.
So your position, or I guess I don't want to, what is your position on the cost that the AGA is excluding, that it is not including everything that, the broader public might consider to be lobbying costs?
Well, it's always been somewhat alarming to me that the costs related to some of these activities were 4% or 5% of their total budget. But there again, I don't know exactly what they would have been or should have been. That's what they state on the bottom of those invoices. But to my knowledge, the utility has never had any idea what that related to. So my testimony is, the commission has traditionally excluded these costs altogether, and that it should continue to do so.
Okay. You'd recommended excluding 50% of the cost of the directors and officers' insurance, and I think 50% of the cost related to shareholder relations. Where did you come up with those 50% numbers?
Well, we had been involved in some cases in Florida, and they do a 50-50 sharing of corporate governance expenses similar to that. And then we also we've participated in a number of gas cases before the Texas Railroad Commission. And in those cases, there's a company called Texas Gas Services company that there was testimony put in early 2023 saying, well, a number of states do a 50-50 sharing on these types of corporate governance costs to share some of those costs between ratepayers and shareholders. And so that has become a major source of precedent since the beginning of 2023. And every gas case, we've participated in almost all the gas cases since that time. And every gas case since, either interveners or staff recommended that that same sharing would occur. All the cases since the Texas gas case that was litigated, all the cases since have been settled, but a number of those settlements actually spelled out there's going to be a 50-50 sharing of these corporate governance costs. And of course, Atmos, most of its operations is in Texas and regulated by the Railroad Commission.
With respect to the D&O insurance in particular, what benefits do shareholders versus customers get from that insurance?
Well, like with all the corporate governance costs, the D&O protects the directors and officers against any types of potential fraud or misstatements to investors through their 10K type SEC issuances, through their reporting on their Form 1 or Form 2 activity in this case, before the FERC. And there's also a protection to shareholders if there's misstatements or any of these types of things before that are considered to be applicable to the D&O insurance. The D&O insurance, it might have some bearing on the operations, like the Mid-States Division and the Kentucky Division here in Kentucky, but generally speaking, those types of legal costs are usually just covered through normal local legal costs. But there could be some that have, some of those directors and officers may have made operational decisions that might prompt some type of suit. And so in those cases, some of those costs could be borne. But our contention is, a corporation is set up not only to serve the needs of ratepayers, but it's also set up for the shareholders to realize profit and a return on their investment. And so there's really no reason for ratepayers to assume all of the costs when those costs are related to not only the operations of those locations, let's say within the state of Kentucky, but also in terms of earning additional profits, and the corporation's going to try and earn as much profit as they can. And that's going to go straight to shareholders, and ratepayers aren't going to get any benefit of that.
You say that, well, I guess firstly, to the extent that it's at, like, say, the Division 2 level, those costs would be allocated according to the cost-sharing mechanisms. Is that accurate?
They're allocated just on the composite allocation ratio, and those are only allocated to the operational divisions. None of those are allocated to Division 2 or Atmos Energy Corporation.
They are allocated though to the unregulated side of the business.
To the different operating companies that are mostly regulated.
And you said that there's benefits to the shareholders. What are the benefits to the shareholders other than perhaps getting a payout from the insurance, you know, in the event that there was a claim?
Well, the benefit to shareholders, there's protections to the shareholders themselves if there's, things like fraud and that sort of thing. Their investments are protected, and, there are no legal ramifications that they would have to deal with in any way. But I would say that those protections to the shareholders and to the directors and officers themselves outweigh the benefit that could inure to the ratepayers themselves.
Thank you. I don't have any other questions.
Good morning.
Good morning.
I'm looking at your direct testimony, pages 7 and 8, lines 13, where you're talking about the test period expenses for the labor costs, and you're comparing the 14 million to the 12 million for the 2024 fiscal year. You say that the increase of 15.5% is unduly high.
Yes.
Can you just walk me through where you're seeing that as unduly high?
Well, the raises that took place were on average 3 or 3.5% on an annual basis, except during 2024, Atmos actually had 2 raises. So I would expect that expenses from the end of 2024 to the end of the test year, which is just a year and 3 months later, would be in the range of 5% higher on a normal basis. Now, Mr. Waller in his rebuttal testimony said, well, one of the things we did was we had a higher capitalization ratio in 2024, so that made the cost in 2024 go down more than they may have normally gone down. And so we budgeted in the test year a lower capitalization rate, which means that more of the money would stay in O&M expense. Now, if you look at the schedule that we were looking at yesterday, it's Schedule G-2, you can see that the capitalization ratio was anywhere from 58% to 60.5% from 2019 to 2023. That's 5 years. And then Mr. Waller said, well, the capitalization rate is 59.7 actual in 2024. So that's 6 straight years where the capitalization ratio is much higher than what Mr. Waller says was budgeted in the test year. And it averaged, the simple average of it is 59%. So his adjustment that he says is related to the capitalization ratio of $538,000 should not be an adjustment. There's no basis for the company to have had a 59% capitalization ratio for 6 years in a row and then go down to a 56.5%. So that piece of the increase in the payroll should not be considered. And then Mr. Waller also said, well, we have these other positions that we've added. And in response to discovery, they said, well, at September 30, 2024, we had 9 vacant positions in Kentucky direct. But then again, he says and I attach that response to discovery as one of my exhibits. And then in his testimony, he said, oh, we added these 9 employees and they were in place near October the 1st. So sometime between September the 30th And October the 1st, Mr. Waller said they added 9 employees. So I'm not sure how that was done, so I know we're gonna ask for a post-hearing data request to try to get to that, but that's part of the reason why the test year expenses are so much higher than 2024, is because the test year includes these additional 9 employees that they didn't have in 2024.
So on October 30th, they were -9, and then or September 30th, 9 vacant position, October 1st of the same year, they filled them. Is that what?
That's
okay.
That's
That-
the
I just wanted to make-
indication that we got, and the two don't seem to agree with each other.
Okay,
I don't see how they would add those so quickly, but, you know, at the same time, they just needed to have added those positions prior to the test year, which starts on April 1 of 2025.
okay. Thank you.
Okay. My turn?
Yep.
I was gonna ask you about the chart on, let's see, it's page, I think 7 of your testimony, table 2, where the labor benefits and employee welfare expenses appear to go down, almost all of them go down from 22 to 23 and then 24, and then are back up for the test year. Is that explained by those 9 new employees?
It's explained by the 9 new employees and the capitalization rate.
And the capitalization?
Those, as Mr. Waller, he has a table in his rebuttal testimony, and he says that I computed $1 million adjustment, and he basically, it shows that capitalization rate accounts for $534,000, and these new employees account for 400 and something thousand. And it pretty much equaled out that million. So it's these additional employees that they haven't had, plus the capitalization rate that inexplicably went from 59% on average over 6 years down to 56.5%.
So we have a set number of employees that we need here. We always have vacancies. But we have to have the money in our budget, assuming we're able to hire them, because we need them. What's wrong with that?
Well, Atmos, I believe, what their contention in the rebuttal testimony was that 7 of these 9 employees were basically new employee additions, as they were replacing contract labor, type costs. So they were
Bringing them
replaced
in.
for the line locators, they were using contract labor, and now they are switching to actually going in-house and having new employees. And so, I don't know if that's something that they had budgeted before, but they refer to it as a vacancy, even though I'm not sure that they've ever had those employees before.
And the expense came off contract labor, or?
That's what Mr. Waller contends, that they reduce contract labor. And he said that that proof is in one of the relied upon files that were part of that zip drive that was discussed yesterday. And I haven't been able to verify that yet, but I'll certainly take a look at that myself. We actually asked the company in discovery in AG 2-02 and in 174, why are these payroll costs going up? And they basically said, oh, we've had some merit increases. But they didn't mention anything about the contract labor. They didn't mention anything about the employee additions. But 2 days before they filed, 2 or 3 days before they filed rebuttal testimony, they filed a supplemental response and put this information in there. So that was new information for me anyway.
And the test year began April 25, so we've had a month of test year now. may have some actuals.
Yes.
And I understand that your ultimate recommendation might differ based on information that comes out of this hearing or in future DR answers, or?
Yeah, I definitely would never agree to the increase related to the capitalization rate, because there's no reason why it should go down. As we've discussed, capital projects are increasing, they're not decreasing. And, but as it relates to the new employees, if there is an offset, with the contract labor, which Mr. Waller, says that there is, and I have no reason to believe that he's not, being upfront about that, then I would consider that as a reason to lower our recommendation potentially. But I haven't been able to verify that.
And then your testimony mentioned a settlement with the Kentucky Department of Revenue in January. Have you gotten the information about whether or not that took place?
I don't consider that to be a big issue anymore,
Okay.
because they did come out with a new assessment of taxes that Mr. Waller is using. Now, I don't agree with his calculations about the property taxes. I'm certainly glad that they reduced the amount by $500,000, but there's still other problems with his escalations.
What are investor relations expenses?
Investor relations expenses, I actually put a link to Atmos's investor relations webpage from Atmos Energy's website. And most of those expenses relate to dealing with shareholders, like various ways to actually increase the level of shareholders, to communicate potential increases in shareholder value to shareholders. It might also relate to debt to some degree, but usually the Treasury Department does most of the work with individual investors of debt. But my understanding is at times that they might provide information to some of the lending institutions as well, but that is certainly not their primary focus. It appears to be to actual shareholders of the company who are looking to earn a good shareholder return, and that's based on company profits to be able to get there.
Wouldn't you normally find that in investor relations in any company, though?
Yes.
Yeah, okay.
Yeah, most of these companies, including Atmos, would have a staff. I don't know how large Atmos's staff might be, but they would make sure that, the 10K reports get published to each one of the potential investor groups and rating agencies and that sort of thing. And deal with actual shareholder meetings and all types of relations with the actual shareholders.
Okay. Yeah, I maybe interpreted that you saw something wrong with that. I was just
No.
clarifying. Okay.
No, our contention is that, the ratepayers, they do get benefit from these costs, but also the shareholders get benefit that the ratepayers don't. And it's because a corporation is a utility corporation is set up to provide service to ratepayers, but it's also to earn a profit and provide shareholder return to its stock shareholders.
That's all the questions I have. Do we have follow-up? Redirect?
I do have a couple of questions. Thank you, Chair.
Mhm.
Mr. Futrell, you were asked questions about the AGA dues, and Do you recall a little bit of the history of how issues in the regulatory community arose regarding dues-paying organizations, like back in the 1980s, 1990s? Isn't it true that NARUC used to audit these agencies, like, for instance, EEI and AGA?
I have heard that, but I was not in this industry in the 80s and 90s, so I don't have any personal knowledge of that.
Okay. And are you aware of whether, isn't it true that NARUC doesn't audit them anymore?
I am not aware whether it does or not.
Okay.
I've heard that they don't, but I haven't personally been involved in looking at that.
And if the AGA wanted, couldn't they offer to their member companies an independent audit that would show expense categories for how dues are spent?
They certainly could.
Okay. Regarding directors and officers insurance, you were asked a question about that. Hypothetically speaking, I'm not talking about Atmos here. Say there is a shareholder derivative lawsuit against the board of directors of a hypothetical company. The directors and officers insurance would kick in to a certain extent according to the terms of whatever the policy says, and provide a defense, and then if there's any judgment levied against the board of directors, that D&O policy would pay for that, correct?
That's correct.
How do ratepayers benefit from subsidizing shareholder costs?
I could not tell you how they would benefit. I don't think they do.
Okay. I think that's all I have, Chair.
Okay. There's nothing else, any reason why Mr. Futrell couldn't be excused? Okay, you're excused, sir, thank you.
Thank you.
I need a quick break before we do Mr. Bodino. Actually, we'll be real quick because I need to take a call. Do you anticipate calling rebuttal witnesses? Noticed you got a bunch of people still here today, or?
I don't think so.
Okay, Mr. Bodino is online, so I need about 20 minutes.
Okay.
Come back at like 10 to 11, and then we'll get Mr. Bodino and wrap up.
We'll be right here.
We are back on the record in case number 2024-276, and we are ready for Mr. Cook to call his next witness.
Call Mr. Richard Baudino.
Mr. Badino, can you hear me?
Yes, I can. Can you hear me?
We can hear you
Yes.
well. Please raise your right hand to
Great.
be sworn. Do you swear or affirm the testimony you're about to give is true and correct under penalty of perjury?
Yes, I do.
Okay, Mr. Cook, you may ask.
Mr. Baudino, could you provide the commission with your full name and business address?
Yes, my name is Richard A. Baudino. My business address is J. Kennedy and Associates, Inc., 570 Colonial Park Drive, Suite 305, Roswell, Georgia, 30075.
Thank you. And are you the same Richard Baudino who caused direct testimony and responses to data requests to be filed in this case?
Yes.
And do you have any corrections or additions to make to those items?
No, I do not.
If you were asked the same questions today, would your responses be the same?
Yes.
The witness is available for cross.
Applicant,
No questions.
staff.
Mr. Bedino, my name's John West.
Good morning.
I'm a staff attorney with the Kentucky Public Service Commission. Did you hear Mr. DeSantis's testimony yesterday?
Yes, I did.
With regard to return on equity, the issue came up involving market risks concerning the use of unregulated entities as a proxy. Can you discuss market risks in general?
I guess you would say, in terms of market risk is something that all companies are subject to beyond any concerns of the individual firm. So there's company-specific risk and market risk. And market risk would consist of sort of broad issues like government policy, earthquakes, acts of the higher power, whatever you want to say, that it'd be something that no firm can get away from, or no industry can get away from. So that's kind of generally what market risk consists of.
And comparing regulated versus unregulated activities, could you foresee circumstances where a regulated utility would have a market risk as opposed to an unregulated entity? So, like with regard to protected market positions, regulated rates of return, would that generally make a lower or higher market risk?
Well, that would tend to, all other things held equal, and I discussed this in my testimony also in response to Mr. DeSantis' use of this unregulated group. Obviously, having a protected service territory reduces the risk. Being able to come in and change your prices when you want to, like utilities can do. They can come in for rate increases. Firms subject to competition cannot always do that. And investors know this. This is why, if I'm just going to refer to my testimony, non-utility group. On page 56, I noted that according to Mr. DeSantis' Exhibit DWD6, page 1, the average ROE results for his non-price regulated group range from 11.29% to 12.53%. Now, obviously, those are returns way in excess of what a regulated utility investor, an investor in regulated utilities would expect. So obviously, there are additional risks and returns that are connected with unregulated firms versus regulated, despite what the criteria are that Mr. DeSantis used to screen his group.
Let me ask you, on the opposite side of the spectrum, could you foresee circumstances where a regulated entity would potentially have a higher market risk if there was extensive oversight or compliance requirements?
Well, I mean, I can't see how that would translate really into higher risk necessarily.
Can you tell us what your proposed return on equity was? I believe it was 9.4.
Yes, for Atmos in this case, it's 9.4%.
And are you aware of the Columbia gas settlement?
Yes.
Can you tell us why your recommended ROE was 9.4, but the Columbia gas settlement was 9.75%?
Sure. Of course, in settlements, that the final numbers that are included in those settlements typically represent a trade-off among the parties or between the parties on a number of different issues. And I think we felt in Columbia that was, a reasonable compromise. And of course, the AG in that case got other concessions on other issues. And so as a whole, certainly considering the settlement as a whole, the 9.75 is reasonable within that context.
And I just want to ask you briefly about flotation costs. Does return on equity generally allow flotation costs? I believe Mr. DeSantis referred to two states that he was aware of, Florida and Ohio, which allowed those costs. I wonder if you could speak briefly on why that should or should not be added into the ROE.
Sure. Flotation costs on equity, are not quantified. The adjustment that Mr. DeSantis sought to add to Atmos's ROE in this case is based on sort of a general adjustment that's not specific to Atmos, and is very small in terms of number of basis points anyway. But the way that adjustment works is to a discount to the stock prices, the actual stock prices that are investors pay in the market. So it's kind of an unrealistic assumption, an unrealistic adjustment. Doesn't reflect real life in financial markets. Doesn't reflect really what prices investors pay for utility stocks. So I think that adjustment is not appropriate and should be rejected. And the Commission here in Kentucky has been very consistent about rejecting flotation cost adjustments.
That's all I have.
I don't have any questions for this witness either. Any redirect?
Just one moment. I'd like to ask a couple questions if I could. Mr. Baudino, you also, your testimony, I believe, also covered the common equity ratio, is that correct?
Yes.
And so were you listening yesterday when Mr. Christian testified?
Yes, I was here for that.
Do you recall him testifying that if Atmos had would have been B rated with a 52.5% equity ratio? Does that ring a bell?
Yes, it does. And that's in his rebuttal testimony also.
Yes. Do you have an opinion on that?
Well, yes, I do. That analysis is just wrong. I believe in his rebuttal, which I have, Mr. Christian came up with a hypothetical that purported to show that if Atmos had not been an A-rated company from about 2014 forward, that the cost of debt would have been 4.55%, I believe, versus the 4.11 that the company currently has, and that is just simply incorrect. It's based on hypothetical that Mr. Christian calculated, and really the thing to know about this is that if you look at the commission's order, if we go back to case 2018-00281 on page 34, this is where the commission began to question these high equity ratios that Atmos has been asking for. And on page 34 of that order, the commission laid out the historical equity ratios for Atmos. In 2013-00148, the company had a 49.16% equity ratio. Okay, in 2015-00343, there was an unspecified, and then in 2017-00349, it had a 52.57% equity ratio. And on that page 34 of that order, the commission stated, Atmos's increase in common equity is concerning to the commission, especially as compared to the proxy companies, which the Attorney General contends have a current equity ratio of 50.2%. So the point of all this is there would have been no change from 2014 all the way up through, I believe, the current date in Atmos's debt cost. Because keep in mind, the commission had allowed Atmos's actual equity ratio to be reflected all the way through its order in case 2018-00281, and that included a 50.06% equity ratio. So the commission, as well as the 49.16 back in 2013-00148. So certainly through that time, there would have been no change in Atmos's debt cost. It was in the 2021 rate case, which I cited in my testimony, where the commission did make that adjustment to its equity ratio, and very appropriately, I would add. And that order came out in 2022. So this whole scenario that Mr. Christian came up with here in his rebuttal testimony, it's just incorrect. It would not have happened. It goes against the reality, really, of how this commission treated Atmos's equity ratio up until the last rate case. So there would have been no higher interest cost, no higher bond cost through that time, in my opinion. And so I did want to get that. I did need to respond to that, I felt, because that was presented in rebuttal. So, and it was discussed quite at length yesterday. The one thing we do know, and one thing that is real, is Mr. Futrell calculated in his testimony that the savings to ratepayers from Atmos's requested equity ratio, in this case of 60%, down to 52.5% would be $5.375 million. That's a real savings. Now, there would be no additional debt cost from alleged down ratings or hypothetical down ratings like Mr. Christian tried to show. And so there'd be nothing but savings and no higher cost.
Okay. How, you mentioned your recommendation of 52.5 for a common equity ratio. How does that compare to equity ratios approved by this commission for other gas utilities such as Columbia, Duke, Delta, and LG&E?
I don't know, I haven't looked up what LG&E's equity ratio was, but it's right in line with Columbia and Delta. And of course, we recently had a settlement in the Delta gas case that the commission's considering. And the equity ratios there was 52.76%, which was Delta's request. So I would say it's very much consistent with that. And of course, as Atmos's request is not consistent with that.
Okay. Chair, that's all I have.
Anything further? All right, Mr. Bodino, thanks very much. And you are excused.
Thank you.
I think that concludes all of our witnesses, and you said you didn't anticipate rebuttal witnesses? Okay. I have exhibits, only one from the Attorney General's office and one from staff. They both were moved to be admitted to my recollection. Any motions at this time? Okay. Written summary of requests out by May 14th. And could responses be in by the 28th?
Yes. Is that Monday, the 28th, is that Memorial Day?
Okay. And then, let's see, our final order is due August 11th, so simultaneous initial briefs, if any, if you want to do them by May 30th. And then simultaneous response briefs, if desired, by June 13th. Any problems with any of those dates? Any holidays I'm forgetting? No?
I
Okay.
think that looks good to us.
All right. I've enjoyed your company. Thanks, guys. Thanks for joining us. Favorite part. You're adjourned.
Thank you.